So just why do central banks raise interest rates to curb inflation? Central banks are public institutions. What does that mean? They are non-commercial and independent entities regulating banks. These banks are tasked with managing the currency of any country. And in the case of the European Central Bank, it is the currency of 19 countries. The sole mission of central banks is to ensure that prices remain stable. So when the prices go up or down, the central bank gets to work. And when the prices go up, it is called inflation. Usually all central banks have a target of moderate inflation. The rate is usually between 2 to 4%. This is known as positive inflation, used to ensure growth. But when it goes above that, that is when the alarm bells start ringing. Excessive inflation is when the central bank jumps in. Now we know that commercial banks lend money to ordinary people like you and me. But who lends to these commercial banks? It is the central bank. This brings us to the question of interest rates. These commercial banks have to pay the central bank an interest rate. This is on the money that they borrow. So the central bank controls this interest rate. If it is higher, these commercial banks also lend money to people at a higher price. That way, everything becomes more expensive. Credit cards, loans, mortgages, it makes everything more expensive. So once things get expensive, people are likely to spend less. If people spend less, demand falls. And once the demand for things falls, their prices decline as well. So the idea is simple: curb spending to curb inflation. This is what central banks around the world are trying to do now. They are hiking interest rates to curb inflation. But this is a slippery slope. If they don't do it right, they risk tipping the economy into a recession. WION now available in your country. Download the app now. Get all the news on the move.